There's a pattern that repeats right before empires collapse, right before currencies lose their value, right before ordinary people wake up and realize their savings mean nothing. That pattern is visible now, more dangerous than 1929, more persistent than the warning before 2008. It hides in plain sight. The financial establishment doesn't want you to understand it because once you do, their game becomes transparent. They call it a yield curve inversion, but what it really represents is the market screaming that the system is about to break under unpayable debt. Here's what makes this moment darker. We're watching the longest, deepest inversion in modern history while those in power insist everything is fine. The gap between what the signal says and what we're told has never been this wide, and history has a brutal way of closing that gap. If you want to understand what's unfolding right now, leave a like and let me show you how this pattern has played out before. We need to go back to where this story really begins, the Roaring Twenties. Picture 1928. America was drunk on speculation. Everyone believed we'd entered a new era where old rules no longer applied. Stock prices only went up. Credit was flowing like water. The newspapers proclaimed permanent prosperity. Sound familiar? But beneath the celebration, something quiet and deadly was happening. The yield curve inverted. Short-term borrowing costs suddenly exceeded long-term rates. Think about how backwards that is. It's like a bank charging you more to borrow money for 1 month than for 10 years. When that happens, it means one thing. The smart money is terrified of the immediate future. The crowd ignored it completely. For 18 months after that inversion, stocks climbed another 40%. Everyone convinced themselves the warning was wrong, but the market wasn't wrong. In October 1929, reality arrived. The Dow collapsed 80%. 1 in 4 workers lost their jobs. An entire generation learned a brutal lesson about the cost of ignoring what the bond market was screaming. Jump ahead 70 years. By 2000, we'd convinced ourselves the internet had rewritten economic laws. Tech stocks were tripling. Valuations made no sense, but nobody cared because this time was different. The yield curve inverted in early 2000. Within months, trillions vanished. Then 2006, housing prices only went up. Remember, banks packaged garbage mortgages as AAA investments. The curve inverted mid-2006, but the party continued 18 more months. The economy looked magnificent. Jobs were plentiful. Everyone said the old indicator was obsolete. Then 2008 arrived. Not just a crash, but complete system failure. Banks that survived the Great Depression disappeared overnight. Millions lost homes. Countries nearly went bankrupt. That same ignored warning had predicted the entire catastrophe. So here we are, August 2022, the yield curve inverted again. But this inversion is deeper than 1929. It's lasted longer than any in recorded history. This isn't a brief warning anymore. It's a sustained alarm getting louder. Yet look around, stock markets rally. Unemployment sits near historic lows. Earnings look solid. Financial media celebrates economic resilience. People glance at portfolios and think danger has passed. This is the trap. False security before collapse. The longer the inversion persists while everything looks fine, the more violent the unwinding becomes. This isn't the signal failing. It's pressure building to unprecedented levels. The calm isn't safety. It's the moment before the break. Here's where it gets interesting. In the 1970s, when the yield curve inverted, the economy broke almost immediately. In 1973, oil prices quadrupled in months. Consumer spending froze. Recession hit like a hammer. Same pattern in 1979. Signal flashes, crisis follows. But this time, something peculiar happened. When oil prices spiked in 2022 after Ukraine, the world prepared for instant collapse. It didn't come. Why? Because households were sitting on $2.5 trillion in excess savings from pandemic stimulus. That massive cushion masked the fragility. People kept spending. Businesses kept hiring. The economy appeared bulletproof. But those savings are vanishing. Credit card balances hit record highs. Delinquencies are climbing. That protective buffer delaying the inevitable is dissolving before our eyes. When it's completely gone, when households have no cushion left, the real damage begins. We're not avoiding the crisis. We're living through the longest fuse in modern economic history. Let me explain what this inversion actually means, because the mechanism matters. The yield curve is essentially a price map of fear and confidence across time. Under normal conditions, investors demand higher compensation for longer commitments because distant futures are inherently uncertain. But when short-term rates exceed long-term rates, something profound is happening. It means the financial world would rather lock money away for a decade than lend it for 6 months. That's not caution. That's terror about the immediate horizon. And here's the critical relationship. The depth of the inversion has consistently predicted the severity of the crash. Shallow inversions preceded mild recessions. Deep inversions preceded economic catastrophes. Every single time from 1929 through 2008, this correlation held, no exceptions. Today's inversion ranks among the deepest ever measured. We're not looking at a shallow warning. We're staring at a signal that historically precedes systemic collapse. That's why dismissing this as just another cycle is dangerously naive. The bond market is pricing in something terrible. Right now, the financial establishment is recycling the exact same narrative we've heard before every collapse. The system has evolved, our models are sophisticated, old indicators don't apply to modern markets, but human psychology hasn't evolved one bit. In 1929, people believed industrial technology had eliminated the business cycle. In 2006, they believed financial engineering had eliminated housing risk. Today, in 2024, the narrative is that artificial intelligence will sustain perpetual growth. Different technology, identical delusion. Every generation invents its own reason to ignore the warning, and reality always wins. But here's what makes this moment genuinely darker. The last time we saw inversions this deep, global debt levels were a fraction of what they are today. In 1929, household debt was minimal. In 2008, it was concentrated in housing. But now, debt is everywhere. Student loans, auto loans, credit cards, corporate debt, and government deficits at levels that would have been considered impossible a generation ago. The entire modern economy is a debt structure. When borrowing costs stay elevated, that structure doesn't bend. It breaks. This isn't speculation. It's mathematics. A household drowning in debt eventually stops spending. A company refinancing at doubled rates eventually fires workers. A government spending beyond its means eventually prints money or defaults. The yield curve isn't predicting a recession. It's showing us the exact point where the mathematics of debt stops working. I know what you're thinking. If this signal is so accurate, why are stocks rallying? Why does the economy look strong? That question reveals the trap perfectly, because rising markets right before crashes is exactly the pattern. Look at 1928. After the yield curve inverted, stocks climbed for nearly 2 years. The market gained 40%, while the warning screamed. In 2006, equities hit new highs even as the inversion deepened. The delay isn't proof the signal failed. The delay is the signal working. Here's the mechanism. The longer everything appears fine, the more convinced people become that danger has passed. They increase their bets. They borrow more. They actually fund the very collapse they're denying exists. That's the psychological trap that transforms warnings into catastrophes. We are living inside that mechanism right now. The longer this false prosperity continues, the more brutal the eventual correction becomes, and the cracks are already visible if you know where to look. Corporate bankruptcy filings are accelerating. Consumer loan defaults are rising quietly. Small business financing costs have doubled. Meanwhile, headlines celebrate employment numbers, but full-time jobs are contracting while part-time and multiple job workers multiply. It's the identical pattern before every major crisis. Surface strength masking structural decay. The yield curve is not just data on a screen. It's the bond market speaking a language most people don't understand. It's the most conservative, risk-averse corner of finance saying something is fundamentally broken. While equity traders celebrate and economists issue optimistic forecasts, the bond market is quietly preparing for pain. That divergence is what makes this moment so dangerous. The calm is the illusion. The panic comes later, and it comes fast. Let's trace the timeline. The 1928 inversion led to collapse approximately 17 months later. The 2006 inversion preceded crisis by roughly 16 months. If that pattern holds, we are sitting inside the danger window right now. And the setup is nearly identical. Low unemployment, high market optimism, asset prices that seem to defy gravity. In both previous cases, people convinced themselves the inversion had been a false alarm because nothing happened immediately. Then the avalanche hit. This time, the global impact could be exponentially worse because today's world is more interconnected, more leveraged, and more fragile than any previous era. Every major institution, banks, corporations, governments, they're all woven into the same debt web. One significant default, one liquidity freeze, one unexpected shock, and the contagion spreads everywhere simultaneously. This won't be just another market correction. We could be looking at a fundamental restructuring of how the monetary system functions. The yield curve, inverted at historic depths for unprecedented duration, is already telegraphing that transformation. What comes next depends entirely on how much longer this illusion of stability can be maintained. But understand this, the longer it holds, the more violent the release becomes when it breaks. History has never recorded a soft landing from an inversion this severe, not once. Pretending this time is different is perhaps the most dangerous assumption anyone could make. The deeper the silence, the louder the eventual crash. So what should you do with this information? The answer isn't panic, it's preparation. The yield curve doesn't demand fear, it demands that you see through the illusion while others remain blind. Because when the system finally breaks, those who understood the warning will be positioned differently. They won't be the ones caught in denial. They'll be standing clear while others ask how it happened so fast. What's approaching isn't just another downturn. This is the unwinding of decades of accumulated excess, leverage stacked on leverage, and institutional confidence that believed it had conquered risk. It will devastate governments that spent beyond all reason. It will crush corporations that mistook cheap debt for genius. It will humble investors who thought they'd outsmarted history. But destruction also creates space for reconstruction. The Great Depression, as brutal as it was, ultimately forced the creation of modern financial regulation. The 2008 crisis reshaped how we think about systemic risk and banking. Whatever emerges from the next crisis will similarly rebuild the architecture of money and debt. Yes, it will be painful, but it will also clear away structures that were fundamentally unsustainable. The yield curve is delivering the same message it always has. The system has been pushed beyond its limits. The pressure is reaching critical levels, and pretending otherwise won't alter what's inevitable. Every calm period before a major storm feels deceptively peaceful right until that first crack of thunder. Then everyone claims they never saw it coming, even though the warnings were obvious all along. But this time, you can see it. You can feel it. The yield curve doesn't lie. What's coming won't simply repeat previous crises. It may fundamentally rewrite how we understand economic collapse, and almost nobody is talking about this, which reminds me, a lot of people watch these episodes but forget to subscribe. If you're finding value here, hit that subscribe button and leave a like. Drop your thoughts in the comments below. I want to hear what you're seeing in your corner of the economy. Final reminder, I'm an economist sharing analysis, not your financial advisor. This conversation is educational. Your financial decisions are yours alone. Think critically, question everything, and prepare accordingly.